Have you ever wondered where people actually buy stocks? Is every stock purchased directly from a company? Or are investors buying shares from someone else? If you've heard terms like IPO, stock exchange, primary market, and secondary market, but they all sound confusing, don't worry. You're not alone. Here's a surprising fact. Every publicly traded company's shares begin their journey in the primary market. But most buying and selling happens in the secondary market. Understanding the difference between these two markets is one of the biggest steps toward understanding how the stock market really works. In this video, we'll explain everything in simple language with real-life examples, practical scenarios, and easy-to-understand comparisons. So whether you're planning to invest for the first time or simply want to understand how the financial world works, this video is for you. Let's get started. What is a financial market? Before comparing the primary and secondary markets, let's first understand the bigger picture. A financial market is a place where money moves between investors and businesses. Companies raise money to grow. Investors buy financial assets hoping to earn profits. The stock market is one of the most important parts of the financial market. Within the stock market, there are two major sections: primary market, secondary market. Although they work together, their purpose is completely different. Let's start with the primary market. What is the primary market? Imagine you've written your very first book. Nobody owns it yet. When you sell the first copies directly to readers, those sales are similar to what happens in the primary market. The primary market is where a company issues its shares for the very first time. This is the first sale of newly created shares. The money paid by investors goes directly to the company. Companies use this money for purposes like expanding operations, building new factories, developing new products, paying off debt, investing in future growth. The most common way companies enter the primary market is through an initial public offering, commonly known as an IPO. What is an IPO? An IPO is the process through which a private company becomes a publicly listed company. During an IPO, the company creates new shares. Investors apply to buy these shares. If shares are allotted, investors become shareholders. Most importantly, the company receives the investment money. This capital helps the business grow. Simple example of the primary market. Let's imagine a company called ABC Technologies wants to expand worldwide. It needs $100 million. Instead of borrowing money from banks, the company decides to issue shares. It launches an IPO. Thousands of investors buy these newly issued shares. The money collected goes directly into ABC Technologies' bank account. That entire process takes place in the primary market. Key characteristics of the primary market. The primary market has several unique features. First, shares are sold for the very first time. Second, the company receives the money. Third, shares are newly issued. Fourth, transactions happen only during the issuance period. Once the IPO closes, those shares move into the secondary market. What is the secondary market? Now let's imagine you've already bought a concert ticket. Later you decide not to attend. Instead of returning it to the organizer, you sell it to another person. The organizer doesn't receive any money. The payment goes directly from the new buyer to you. That's exactly how the secondary market works. The secondary market is where investors buy and sell shares among themselves. The company is no longer involved in these transactions. The money moves between investors. Examples of secondary markets. The world's largest stock exchanges are examples of secondary markets. Every day, millions of shares are traded on these exchanges. Investors buy. Others sell. Prices constantly change depending on demand and supply. This is where most stock market activity happens. Example of the secondary market. Suppose you purchase shares of ABC Technologies during its IPO. A few months later, the company's performance improves. More investors want to buy the stock. You decide to sell your shares. Another investor purchases them. Who receives the money? You do. The company receives nothing from this transaction. This is the secondary market in action. Why is the secondary market important? Without the secondary market, very few people would invest in IPOs. Why? Because investors want flexibility. They want the ability to sell their investments whenever they choose. The secondary market provides liquidity, price discovery, transparency, continuous trading, fair market value. This makes investing much more attractive. Primary market versus secondary market. Let's compare them side by side. Purpose: primary market raises money for companies. Secondary market allows investors to trade shares. Who receives the money? Primary market. The company receives the money. Secondary market. The selling investor receives the money. Shares primary market, newly issued shares. Secondary market, previously issued shares. Transaction primary market was company to investor. Secondary market, investor to investor. Frequency primary market, only during new share issuance. Secondary market trading happens every business day. Price primary market, usually fixed before the IPO. Secondary market changes every second based on demand and supply. Risk primary market. Investors rely mainly on company prospectus and future expectations. Secondary market. Prices fluctuate continuously depending on market conditions. Real-life analogy. Imagine buying a brand new smartphone. When you buy it from the manufacturer or an authorized retailer, that's like the primary market. Later, if you sell your phone to a friend, that's like the secondary market. The manufacturer doesn't earn money from the second sale. Only you and the buyer are involved. The same concept applies to stocks. How both markets work together. The primary and secondary markets are not competitors. They support each other. The primary market helps companies raise capital. The secondary market gives investors confidence that they can sell their shares later. Without the primary market, companies couldn't raise funds efficiently. Without the secondary market, few investors would be willing to buy IPO shares. Together, they create a healthy financial ecosystem. Who participates in these markets? In the primary market, companies, investment banks, institutional investors, retail investors, regulators. In the secondary market, retail investors, institutional investors, mutual funds, hedge funds, brokers, market makers, stock exchanges. Advantages of the primary market. Companies can raise large amounts of capital. Businesses expand without taking excessive loans. Investors may buy shares before market trading begins. Companies gain greater visibility and credibility. Advantages of the secondary market. Provides liquidity, makes buying and selling simple, helps determine fair market prices, encourages long-term investing, supports overall economic growth, creates transparency. Risks to understand primary market risks include: the company may not perform as expected after listing. IPO prices can sometimes be overvalued. Future growth is uncertain. Secondary market risks include daily price volatility, market crashes, emotional trading, economic uncertainty, company-specific news, common beginner mistakes. Many beginners think buying shares always means giving money to the company. That's only true in the primary market. Another misconception is believing IPOs always generate profits. In reality, some IPOs perform exceptionally well, while others fall below their issue price. Similarly, many people think stock exchanges create new shares every day. They don't. Most daily trading involves existing shares changing hands between investors. Quick recap, let's quickly summarize. The primary market is where companies issue new shares to raise money. The secondary market is where investors trade those shares with each other. Primary market equals fundraising. Secondary market equals trading. The company earns money only during the initial issuance. After that, investors trade shares among themselves. Both markets are essential. One helps businesses grow. The other keeps investments liquid and active. Final thoughts. Every stock you see trading today started its journey in the primary market, but its life continues in the secondary market, where millions of investors buy and sell shares every day. Understanding this difference helps you make smarter investment decisions, better understand IPOs, and build a stronger foundation in the world of finance. Remember, successful investing isn't just about choosing the right stocks. It's also about understanding how the market itself works. And once you understand that, you're already ahead of many beginners. If you found this video helpful, give it a thumbs up and share it with someone who's just starting their investing journey. Subscribe to BNR Universe for easy-to-understand videos on stock markets, investing, personal finance, business, and the global economy. And in the comments below, tell us, if you had the opportunity, would you prefer investing in an IPO through the primary market or buying established companies in the secondary market? And why? Thanks for watching, and we'll see you in the next video.